succession, which succession planning can be an awfully broad stroke. I know just prior to this today, Paul and I were chatting, it can span obviously from what immediately comes to mind of passing on of a business, however that might manifest, with that to family or to an outside buyer or whatever it might be. Could even be succession of key personnel, which is also obviously a big thing. So I mean, it's a topic that's so broad and so often overlooked. It's something where I know just even within the greater Bemidji group, we've talked about how this is sometimes maybe even in missed out opportunity, because oftentimes there are aspiring entrepreneurs and or folks that are thinking, hey, I just want to get something started, but then they don't quite have the idea to gel. Yet simultaneously, there's someone saying, I think I need to pass on my business and be done. How those connections can happen or can be made is sometimes crucial to the fabric of a small town economy. And so there's a lot of interesting aspects. So anyways, that's our discussion topic today. Today we have, actually I might even just let them introduce themselves. We've got Grant Oppegaard.
Grant Oppegaard, I'm with the SBDC. I think I know most of the folks here, but I'm not an expert on succession, but I often get involved with the clients who are both buying and selling. They'll negotiate their own price, but I often get involved with them. And because I have a lot of details in their business, I try to help them look at different options or issues that come up when they're buying or selling, especially if it's within a family, father to son or daughter. So that's kind of where I come into and can maybe help a little bit on bringing up some of the issues they run into. But the real expertise in the tax area and everything is Dane. So
thanks, Grant. I'm Dane Jones from Krigbaum and Jones accounting firm. We deal with buying and selling businesses, maybe not on a weekly basis, but I'm talking to clients at least once every 2 weeks about, maybe the client wants to get out of business, maybe somebody's looking at another business, and so we're deeply involved in that. Every industry has their own methodology or rules of thumb on valuation, and I'm certainly not a business valuation expert or anything like that, but I do understand cash flow, and I always tell them, somebody might say that, oh, my business is worth $1 million, and I'm thinking, well, you got $100,000 of equipment, and why would it be worth $1 million when I can go buy that equipment for $100,000, have a little startup cost? And so the clients then kind of understand, well, maybe I am a little unrealistic here, and that's good for them because they may not be putting enough away in retirement at that point, or think that this is worth $1 million and they get to retirement and they have $120,000. So we deal with it quite a bit, and I prepared for this just like college, and so I didn't bring any notes or anything, so we'll open it up.
Thanks, Dane. And to be fair, so did I. I've got a blank notebook in front of me, but the whole point here is actually to generate a discussion. And so even to kick it off, there has been some plans that have been thrown in the audience just because they have got some experiences that directly relates to this type of thing. Just curious, show of hands if you want. Who's been a part of a sale or a purchase of an existing business? It's got kind of a fair amount of the audience. So please share your wisdom as we kind of talk through this today, because nothing quite is as helpful as an anecdote. I know. So on myself, I don't think I introduced myself, but I'm Bud Kaney. I work with Greater Bemidji as a bit of an entrepreneur consultant, but then I also am co-founder of Bemidji Brewing, and so there's an aspect of some understanding I got, but I can tell you I've never bought or sold a business in my life, and so a lot of it is a lot of smoke and mirrors, and there's a vague understanding of what might go on, but I know from my standpoint I'm extraordinarily wet behind the ears totally naive on this. So please help me come up with some questions too. So maybe to start on this, I know one thing that both of you have helped folks with, and has been, just as you were just saying, Dane, valuation. It's a squishy thing. Is there, where does anybody even start?
Well, you know, every business is unique. So we always look at, you know, cash flow has a certain value to it, but you've got some assets, and you know, that's what your low value would be. So if we're looking at buying a business, we've got assets that have a value to it that's somewhat easy to determine, as long as it's not, you know, very unique. So we have that, and so if we want to get more out of that business, and we have, say, $100,000 of equipment or assets, then can this business afford to pay, you know, that buyer a wage, or maybe they have a manager? Can that business afford to pay, you know, a return on investment and get to the point where, hey, I'll be willing to give you $200,000 for this because I'm going to make some good money at this over the next 3 to 5 years. And so just knowing that, and a business is going to be more valuable if the owner is not the one making all the decisions. The less an owner is involved, the more an investor can step in and say, hey, they've already got their management team in place. I don't have to do that. That person is walking out the door, and half of their clients aren't following because all this, you know, workforce is in place and that business model is there. So, you know, the less owner involvement in a business, the easier it's going to be to get that value. For me, I'm an accountant. If I was a one-person show and I wanted to sell my business, half of my clients aren't going to return because they don't have the relationship with that individual that they do with me. So that's a very scary sort of selling arrangement or buying. And so I have several staff that have those relationships. So in my case, I'm not worried about that.
Sure, so that mitigates some of the risk.
Yeah.
Okay. Now, I hear sometimes about different types of valuing methods too, such as like EBITDA or even like book value. Is there either one of you be comfortable kind of sharing on that, Grant?
I'd mentioned that when I work with my clients, 75% of them will end up selling their business for the current market value of their assets. There won't be any goodwill or blue sky involved. When they're, and usually what happens is someone's in business for a long time. They maybe bought their grocery store, I'll just use an example, for $30,000 30 years ago. They don't owe anything on it. The business makes enough money so a buyer could come in, look at the replacement value on that grocery store, even if it's in a small town, and say, well, the store would probably cost $100,000 to build, and they've got $20,000 in equipment. Usually what happens is that thing will sell for around 120, maybe another 10,000 more if they have good records and a customer base and a solid name and things like that. But usually it'll sell for market value with no goodwill. And the person selling it, because they have everything paid off, they've got some of their retirement dollars. And if they're realistic, like Dane was just saying, then that's, you know, they hope to make a little more, but they've made some serious money for retirement. The exception is, in valuing a business, when I try to take a look at what it's likely worth, I look at the tax returns to see what kind of cash flow there is, and I look at the assets, and I start with the same thing Dane said. Here's the market value of the assets, the hard assets. And by the way, almost all businesses are sold as an asset buy. Very seldom does someone come in and buy the business, the stock of the company, or a stock sale. Almost always it's an asset buy for reasons that a lawyer will explain more. But here's what often will make up what I call blue sky or goodwill. If you happen to have a patent and it's actually protectable, if you happen to have something unique in your business that makes your business make quite a bit more money than other businesses in the same business. And I can give you an example of a boat dealer who had all the records on how to repair Yamaha outboards, going all the way back to the first Yamaha that came into this country. And that was started out to be a hobby of his, collecting all these repair manuals and all these parts books. In the end, he was the only person in a big region that could repair those engines and had the information and how to look at superseded parts, all this stuff. But what was interesting is he also had a gentleman who was the repair guy working for him. So he wanted to sell the business. The fellow would like to keep working, he was the expert. And literally, those records of his covered the entire wall like this. And he had those records. And so I put a value on that business because his repair business in the town he was in with the number of units he's selling in that, let's just say it should have been 200,000. His was 400,000. And he could charge a good solid hourly rate because no one else knew how to really fix them. And for that reason, he ended up with about a $200,000 blue sky value in his assessment of the business. So it came down to market value of the assets, the appraisal of the building by the banker, and then roughly somebody takes a look at his equipment and furnishings and say, yeah, you could probably get 50 cents on the dollar for those. And then here's the value of those records that you have and the repair moving with the business. That is kind of a evaluation that the financial tax service like Dane would absolutely know what to do with that if he knew it was there. The difference between myself and a lot of tax people working on businesses is a lot of times the owner doesn't tell them about this thing, doesn't realize, you can tell your accountant what you got here because then if they're doing the valuation for you. That happens a lot. And one other thing I would say is relates to that, sometimes it's the opposite. Sometimes the owners don't clean up their books, they get ready to sell the business, and the person, especially if it's going to their son, there's big family problems when you start looking at what is the business really worth and what do the books say it's worth and what kind of back taxes might be owed. I run into that, I would say, once or twice a year, and usually it's a major family problem. And it's unrelated to the appraisal of the business, and it's unrelated to the accounting firm because they did the book, they did the taxes right. It was the internal books and the owner of the business saying, I'm going to run it this way because this is the way I want to run it. Not realizing is that's fine until you get ready to sell the business. Now there's a big problem. So I run into those kind of things which I try to help the clients work out. And I've sat in more than one family meetings with 3 brothers, a daughter, and a mother and father trying to work out how we're going to handle this. So my involvement is strictly in what I would call the non-financial analysis, trying to figure out options and unique ways to deal with the problem. Many times, or I should say most of the times, the tax returns are very, very close to what's real. And I always say to my clients, especially if they're of any size, be sure to, 1, ask your accountant and tax service what they think your place is worth, and 2, here's my opinion, and 3, if you really want to, you can hire a firm that will give you an official appraisal. Edina Appraisal Services out of Minneapolis I've worked with on different times. But they do cost between $5,000 and $15,000 to give you an evaluation of what your business is worth. And I'm not familiar with too many others. Dane probably does, but
You're talking, it's not like your normal real estate appraisal for $700 to $1,000. It's $10,000 to $15,000 to get a business appraisal. So it may have its benefits there, but generally we're going back to some cash flow, or if my client's selling, it's just like, all right, you don't want to chase away a good qualified offer, and so we don't want to shoot for $1.5 million when 1.1 is a really good offer for that industry and the assets that they have. So you really got to understand what's realistic and what am I going to walk away with after taxes and paying down any debt, and then can I live on this? Or if I can't, we've got to keep this business going for 3, 4, or 5 more years, pay down some debt, get our finances in order, and then we can kind of walk away and sell for whatever the realistic value is.
But I have a question.
Yeah.
I kind of want to hear, I know the plans that you have in the audience here, but I want to hear some real life experience from something that Dane had said about that ownership that you have over the business and being able to see the big picture of moving on and transitioning to someone else that's owning the business. So Dane, knowing me and Harry, you're kind of serial entrepreneurs. So do you feel like that was the struggle, is that you have this ownership of the business, you want to see this legacy continue? I'm thinking of 2 specifically in town, but I'm sure that there's more. Can you talk to maybe, did you have someone in mind? Did you plan further ahead than you thought you needed to find somebody to take that over? How did that happen? And how were you able to transition from your experience? Or were they totally different?
For each business?
Yeah.
Okay, well, Harry and I are the original owners of the pub and sub shop, and we had that for 32.5 years. And overlapping, we also have the Cabin Coffee House for 13 years. So I'm going to let Harry talk on some of this because he was the background business guy, and he's the one that had the business degree. How far in advance? When we sold the sub shop, I don't know how long the period that took, but we ended up selling to our manager.
Yeah, the process of what I think a lot of people are uninformed about is number one would be valuation, what people think their business might be worth and what it's actually worth can vary greatly. And what a person is willing to pay for a business may not have any validation with a banker who is willing to finance it. So then, especially in very small businesses like ours, what are your options? Well, most small businesses like we had, and the number of years we had them, we didn't have any specific debt that we had to service, so that gave us an option of financing them for a portion of the sale, and a lot of people don't like to think about that, but oftentimes that's a very key part of the equation when there are people who want to purchase your business come in there. You may have to carry a portion of that debt for a period of time with the understanding that you may not receive anything for that. So I think if a person wants to consider selling your business, that planning ahead is very important, and talking with your accountant, and I had a number of conversations with my banker because they deal with these transactions all the time, and so they're relatively versed in what things are going to, what they're going to be able to finance in a business sale. So I think educating yourself is a very big key in all of that.
Your banker is gonna give you some free advice. And when they say no, it's not worth that, or you don't have enough down, that's the sign. You can go to 10 different banks and you might get a yes, but when they say no, there's a reason for that. They're taking too much risk.
I agree with that 100%. Most of the resorts that I've been involved with that have been sold in the last year, two things. One, just what you said, the owners usually will end up carrying 10% of the sale price themselves, and the bank will finance the other 90 if you have enough owner equity down. But if you're paying too much for that, the bank really doesn't care how much equity you got. If you're paying too much for a business, they don't want to own that business and they won't finance it. And I would add one other thing. Often an owner will say, well, I want $1 million for my business. And I'll say, well, let me take your business. You run it real well this last year based on your taxes. You made $50,000. Somebody buys your business, runs it exactly the way you did, and finances $1 million with $200,000 owner equity and $800,000 borrowed. They will lose $47,000. Ain't gonna happen. Just not gonna happen. No bank will finance it, if they could get to finance it. And anybody who is got $1 million is too dumb to give you $1 million for it, not go through a bank. And that truly is what happens. So many owners start getting realistic when they kind of put themselves in the place of the person who's going to buy the business. You can do a 3-year financial projection, and like Dane said, the cash flow will just, here's your interest, but you also got to take into consideration your principal in your cash flow. Even though it's reducing debt, increasing net flow or net worth, all that stuff, try not paying it every month. It's an expense you have to take into consideration on cash flow. So a lot of times, the owners then start getting somewhat realistic as to what they think they can sell the business for. But quite often, the deal gets put together because the owner says, if you can come up with 90% cash, I'll carry $100,000 for 5 years. You don't have to make any payments your first year. And so it's a little bit like any deal that can, or any agreement that can be put together between the buyer and the seller, an attorney can put into a purchase agreement. And so I would say it's more common than not, just as you mentioned, that often the seller does end up carrying some of the debt load, but usually not much.
It all goes back to cash flow.
Yeah. You'll see something, you know, the kids will get or buy in from their dad. And when they do, 5-10 years later, they reinvented that thing. And dad was just coasting, and they took this thing and went bang with it.
Yes.
In other cases, they ride on what mom or dad did, and 5 years from now, there's nothing left. On the other
You gotta
end.
change.
And it may not be the value at the point this decision was made, it was the ability to do it.
You know, cash flow, Grant was talking about, tax returns are generally pretty good. Well, my clients were looking at buying a resort. So my clients and their banker are in the meeting with the seller, and we're talking, and the guy said, I keep $30,000 a year in cash and I can prove it. Well, the banker throws his arms in the air. He can't use that because he's got to justify things based on tax returns and financials. And he had a sophisticated system, so he never deposited cash. He deposited checks and credit cards. And so what that did is it cost him $350,000 on an appraisal. And that business would have sold that day. But he wanted to save 10 grand a year in income taxes, and it cost him $350,000, and I thought it was pretty hilarious. Yeah, it's like, you just do the things the right way, keep all your stuff in order, no skeletons, because they're going to come out if it's a big business. There'll be a team of accountants that come in and analyze the monthly books for the last 3 years and wonder why the cost of goods percentage is off 2% this month compared to other months. And so that's something that was been a kind of an eye-opener as we let small businesses that grow kind of do things the old school way. When you go to try and sell that, your books better be in very good shape.
So in all honesty, did he think that he was doing it correctly though too?
No.
Like he didn't? He
No,
just
but
was-
then, you know, our response is, well, how do we know you're not using that for the snowplow guy or the maintenance guys? So it's not adding, he thought it added 30 grand in cash flow, which $2,500 a month in extra cash flow over 20 years is a boatload of money. Yeah.
I can give you an example of a horror story that's hard to believe that just took place this last year. My client asked me, he was the son, he asked me, what do you think I should pay for this business? I'm curious. And the father has asked $5 million. And I did what I thought was a reasonable appraisal and came up with $4 million. And I said, I just don't understand how he came up with $5 million. I took the tax returns, went through them about 3 times. Finally sat down with both of them and I showed the father, I said, here's how I come up with $4 million. How can you come up with $5 million? Is it all goodwill? Because it doesn't make sense. And his answer was, well, I got another $1 million inventory that isn't on my tax returns. This guy's been in business for over 20 years. And I said, really? Yeah, he said, that's the way I run my books. I said, what does your accountant think? Well, I use a large accounting firm in Chicago. And I said, I gotta tell you, I said, my opinion is that when you take this physical inventory at the end of the year that you just did to sell to your son has gotta start with the right number or he's gonna be in trouble. The father's answer was, there's no damn way I'm going to pay another $400,000 in taxes. I've paid enough taxes in my life. So I asked him, I said, does your accountant know, your accounting firm in Chicago know, you know, that your inventory is understated by almost $1 million. He had multiple locations, by the way. And I said, have they ever been in your stores? I said, you know, I've been in 3 of your stores. And I said, this shouldn't, you know, this is kind of, I think, pretty obvious then that there's something really wrong with your internal books. Well, call and ask him, he says, because he thinks it's worth $5 million too. So I did. At his request, I called the owner of the firm in Chicago and I said, the number you have here on inventory, if my client told you that it was $1 million low, what would you do? Well, we immediately amend the tax returns. You'd owe a bunch more taxes. Father was also listening, by the way. End of the deal was this. The father paid the taxes. He's fortunate he didn't get audited and get charged with tax fraud. The son loaned him the money to pay the taxes because he would not pay him without his son loaning him the money because he's not going to pay any more taxes, he said. And he's going to take care of the loaning as well. The son at least is starting with the right number. If he had not done that, and one of the things I think that finally convinced the father that yes, that's what we should do, is said, you know, right now, your son is innocent. If he does the same thing, if he starts with this phony inventory number, he's going to get charged with tax fraud if he ever gets audited. And it's as simple as that. This person made a lot of money over the years, and he's still got, his son has got tremendous business going. They make very good money and everything. But the bottom line is, when you have books that aren't trued up and you keep pushing everything ahead of you, it ends up burning you one way or another. And in truth, he actually made more money every year for the last 10, 15 years, but he kept undervaluing the inventory to the point it got to be down $1 million, just short of $1 million. In this case, The transaction went through, son loaned the money, father paid the taxes. I don't think it'll get audited by the IRS, they're pretty busy, but if it ever does, at least my client, the son, is okay. The father may end up paying some penalties or some kind of interest or something like that. But the accounting firm, they had to use the numbers, you know, it says right on the front, the numbers are supplied by the business owner. And I've run into that many times. Once in a while, we had one client that actually got $45,000 back after I got him to use Krigbaum and Jones, and they straightened out his books for him. But he had the opposite. He had a inventory situation that he had overpaid his taxes by $45,000. But one of the horror stories I'm talking about do happen. Most of the time they're unintentional. Sometimes they're intentional. It's just plain tax fraud. But most of the time, people just are not inventory control specialists and they don't know, and you can't write off stuff and keep it and so forth. But when you're getting ready to sell the business, especially if it's to a son or daughter, you want to be sure your books are right. You don't saddle them with potential problems. That's why I think as you start thinking about selling and planning, and this father and son contacted me about a year ahead, that they wanted to start thinking about transferring the business. And I met with them with their banker, and the banker was fine with it and so forth. So, but what happened was during the time, I got to understand their business a lot better, but I didn't understand that inventory because I hadn't been to all the locations and didn't understand that, where he was parking the inventory was in his quote clearance operation, and just didn't understand it. But the tax returns jumped right out at you, and some of these situations like that could have been a real disaster for the son had it not got cleared up. I also have one client that I know that went bankrupt because he paid his father way too much for the business. And then 5 years later, he was bankrupt.
A lot of times those family sales aren't a good deal.
Not unless they're looked at by somebody.
It's what the exiting parent needs to retire. It's got no valuation on the value of that activity.
Hearing the amount of transactions you've been custodian of, Dane, and hearing about all these familial passing on to progeny, what sort of percentage do you see through your office that are family passed on, and then what of them are non-family?
I'd say maybe a third are probably family. Kind of just depends. But most of them are, selling to possibly an employee, possibly selling out to another partner, or just maybe even selling out to a regional competitor, and those sorts of things. So there's all kind of different areas there. They all have their own issues as far as the family thing that Grant touched on, and various things that happen there. But the worst thing about not having accurate books is when a business is in trouble and Grant goes in to take a look at things, you can't give them the right advice. They might be doing everything right, and now you're telling them they aren't making enough in margins, and they change it, and they've got these things, too many variables off to the side that they can't compute, and Grant doesn't know anything about it. So keeping good books is going to be the key to making sure things go smoothly. We can give advice on, what the cash flow is. If they do get in trouble, we're giving them the right advice.
I'd say 80% of small businesses do have good books. Most of people I work with, even though they may not understand, a lot of cash flow and accounting in general, they understand their business, and usually their books are pretty good. And but when there's an exception, there is an exception.
And the timing is just you gotta plan 5 years in advance.
Yeah.
So just like when we sell a house or we sell a business, or we should say just sell a brick and mortar space, there's certain things that we'll do to update the space before we sell, right? And so obviously it sounds like books and planning for your books well in advance is important. What other considerations would a business owner want to take into, what other considerations would a business owner want to think about when it comes to, let's say they're planning 5 years in advance, could they start to, whether it's improve upon or look at, so that they can get more of that sale?
So they're going to, you want to be able to identify the expenses that are not going to apply to the new owner. So there could be some health benefits, there could be, some family wages that are excess wages. You got to identify those expenses that aren't going to apply, so you've got, a reason to add that back to your cash flow. Sometimes people say, well, I'm going to cheat the system for years and years, and then 4 or 5 years before I want to sell, my books are going to be the books. Well, you never know when you're going to need to sell. It could be health, you could just be tired of the industry, or somebody else is coming in and you're going to lose some money at it. So yeah, there are certain other things, if there's some excess assets, if there's a lot of fixed assets that aren't producing anything, go ahead and liquidate those things and get a little bit more value, as long as it doesn't hurt your cash flow or your ability to do business. But yeah, it's similar to, investing, $1,000 here to, maybe get another 1,500 or some curb appeal. It's similar to that.
In 1977, I was looking to get into a business, and a local coast-to-coast hardware store was for sale. And so after looking at the books, I thought perhaps that was the number that I could purchase this business for. Well, he had been writing the business, the inventory in half, is how he did his books. So I had to come up with more money to buy the business, and then we did formed a partnership, and we relocated out to the Paul Bunyan Mall. Unfortunately, the business only lasted 4 years. There were things that started to happen. The daughter was going to college, and then he thought, well, that money could just come out of the till to pay for her tuition. Things like that. And so it just got worse.
Partnerships are tough.
Yes, yes.
Yeah, and the other thing that he insisted on too was that he wanted to do the deposits. But I noticed a lot of times the cash drawer would be left open, and he was quite good at calculating the price. 5% tax on an item that a person had, and the money would go in, and it was never run out.
Mm-hmm.
And at the end of the day, then that money went in his pocket.
That's when you know that how you operate and how your financials look don't match up. There's some issues. So we're involved in a lot of bars and restaurants, and it's just ripe for fraud. And so you got to be able to just put every dollar in that till, show your total revenue, because we know we buy a bottle of beer for 75 cents and we sell for $3. So we know our margin should be. And when it's not reflected that way, why is it? Well, sure, we got a happy hour or some employee discounts or whatever, but if there's too many variables as far as paying cash out of the till for help because somebody's on unemployment, or paying some other things, you just lose the ability to analyze things and not know that you're pricing your product right. And in that case, your standard markup is 50% or whatever that number might be, and when your sales and your costs don't reflect that, you got to be able to dig into it and figure out why.
Or like your guy that was running his inheritance through his P&L, made it look kind of nice. The business went like that.
I think another thing that an important consideration, is if you have a business that is dependent on key personnel, and I was involved somewhat in a business that sold, and when the business changed hands, employees didn't care for the new management, and a lot of key employees left, which left the business without any means of producing any income. And so I think that it's important to keep your key staff involved in the process so that they're comfortable with the transition, so you can show a prospective owner that, yeah, these people are involved with this transaction, and here's the reason why, because you don't want to lose these people because a substantial portion of your income is dependent on their production.
And there'll be, key personnel, employment agreements. If you go into a business and say it's a insurance business and you've got some good producers, you buy the insurance agency, you want to make sure those producers are there, so you may need to have them sign a contract that they're going to work for you for a period of time until you can understand the clients and transition things. It's kind of tricky because the seller doesn't want to let their employees know that they're selling too. And so it's just a matter of balancing that out.
I think that comes back to knowledge transfer, and if you set up your business, I used to work in corporate, and so we had SOP after SOP. So if you have standard operating procedures, that's a really easy way, when everything's documented, to make sure that that knowledge transfer is there, if you have to bring someone in, without letting your employees know that you're selling the business. It's just whether you're delegating to have them write all these things up, and what they do every single day, and what vendors they work with, or however it works. When we were doing a lot of training, cross-team training, we would have them do that work for us, so that we didn't have to do all the work, and it helps when it comes to transition. And when you talk about succession planning and bringing in key people, that's very valuable, because a lot of those people, they have so much up here, and in order to get that out, you have to create processes to get it on paper. So we found that to be really, really valuable when it comes to transition.
And a lot of times there will be a compensation agreement for a period of time after a sale, whether it's 6 months or a year or whatever it might be.
I've had an experience this summer. George Berger lived in Erskine, held more patents than anybody else in the state of Minnesota when he died. His last daughter-in-law's almost 80. She has all this and wants to get it in a museum or something. All the letters and all this stuff that's saved. And he was an unbelievably creative guy who was a terrible businessman. But he always wanted to run his own stuff, so his life was like this all along. What's left of the business is now a new building on the west side of Boston. That's the old Erskine manufacturing plant. But I mean, he did stuff that was unbelievably creative. The very first one was a clothespin on a spring. That was his. The 16 millimeter projector that didn't catch fire, so they could have them in movie theaters. Farm equipment, building equipment, the Berger snowplow sold all across the nation. The cruise control on your car, it just ran out of him. And when he died, I don't think he owned a nickel. It was just one of those kind of things that he could not manage his brain, because his brain was always inventing new things. And if he'd had somebody running all this stuff, it'd be a different world for his family today. It's just a disaster on one end, and unbelievably creative on the other end.
Grant, I know well, both of you both mentioned cash flow a lot. There's, and you've kind of predicated it by acknowledging how tax forms kind of are a great way to derive that number. But at the same time, cash flow is oftentimes described as a different thing for different people. Would you mind defining that a little bit further in terms of your experience?
Yeah, I guess I can say I use the real simple approach. Taxable profit, add back depreciation, subtract your principal payments. That's how much cash you're gonna have, and it's usually more than your taxable profit. In the profit and loss statement, which Dane will really be able to zero in on, but for a simple reason, I use this because it's about 95% correct. It assumes that you pay your bills in 30 days, you collect your bills in 30 days. It assumes, a lot of things that don't really happen, but they're close. And if you take your taxable profit, everything on that sheet is real. Sales are real, cost of goods are real. Every expense, money out, except depreciation. That's a gift from the government. So if your taxable profit is 40,000, and your depreciation is 40,000, big taxable profit, add the other 40, now you got 80,000. If your principal payment is 20, your tax flow is 60, you pay taxes on 40. Many times you'll hear people say, well, I pay taxes on 40, but I actually make 60 or 70 or whatever. And it's true, they do. The problem with, I'm a business person, and I understand totally that a trained professional accountant will tell you principal reduces debt, increases net worth, it's not an expense. And I said, and I agree 100%. But what I'm trying to tell them is you always got to have enough cash to pay your bills. Cash is king. As long as you got cash, you're in control of your business. You've got to take into the fact you've got to pay that principal every month, or the bank will be over to see you. So that's my formula. There's a whole lot of real sophisticated formulas that professional accountants can give you, but that's what I start with when I look at the cash flow to see if it'll work.
Yeah, it's just a matter of how I just look at the front page of a corporate tax return. We've got our profit, add back the depreciation and interest. That's how much money we've got available to make loan payments. Can that $10,000 a month pay for whatever you're buying over whatever period of time? And so we know equipment's gonna go down in value and be maybe worthless after 5 years. If we're buying real estate, we generally want to be able to pay for that real estate in 15 years. We might stretch it to 20 for commercial, if it is a good fit. And we always look at it as far as 100% financed, because any business will work if an owner or a buyer comes in with all cash. It'll cash flow. But that cash is being taken from somewhere else and not earning that rate of return somewhere else, so there's a cost to it as well. So if the business is for sale for $500,000 and it's all equipment, I run an amortization schedule at whatever 5.5% interest for 60 payments, and what's my monthly payment amount? Is that going to equate to that annual cash flow? And so it all goes back to that for me.
So when you're a buyer and you're looking at that potential sale, you're assessing your ability to pay for that, is what you're saying. And I know Grant mentioned that earlier. How about on the other end too? What if a lot of businesses are carrying kind of cyclical debt or some sort of residual debt perhaps? What do you remove that from the equation? Because obviously that's cash flow out in terms of real dollars.
For the seller.
Yep.
But for the buyer, I'm not assuming that debt.
Yep. Okay, so you kind of remove that from the equation to assess the value of the business.
One of the things that often enters in, which gets to be kind of a fun exercise, and that is, yes, they were doing 200,000, but I'm going to open up for breakfast and they only were lunch and dinner. And so now I'm gonna generate another 100,000 in business in my business plan. And some of this stuff is fixed and some's variable. Now what's gonna happen? Usually, and this quite often happens in restaurants and in bars and in different businesses, my business plan is I'm gonna do things differently and sales are gonna increase. And I'm gonna use my two daughters who are 15 and 17 and still in school. I wanna use them as, you know, and I don't have to, they're gonna be employees of us, but I don't have to pay them. Now what's gonna happen? And that's the part that gets interesting.
Yeah.
And that's the part where between yourself, between myself and the owner, you talk a lot about what's feasible. You know, can you increase the business 100,000 without adding equipment to the kitchen? You know, can you really do this? And if the answer is yes, a lot of times, new person will buy the business, cash flow it, and make more money than the previous owner, or make as much as the previous owner and are paying down debt at the same time. So I would say a good part of many businesses do have new owners with new business plans, and a lot of them work. I've seen businesses do 200,000 and the year after they get bought, they're doing 400,000.
Sure.
Just big changes.
Just freshening up.
Seems like the hardest part is accepting what your business is worth when you sell it. You've spent, 10, 20, 30 years of your blood, sweat, and tears working, and man, you think it should be worth that $10 million, but in reality it's $150.
Right.
Like
It's
you
hard.
just gotta have to get past that. Another question is, where do you begin? You don't want to just put a sign in the front door for sale. You're going to have a million people knocking on your door, say, I want it. How do you vet those buyers, potential buyers? And how long, how many years in advance do you start?
5 years.
5 years.
Because it might take some time to get to the point. Well, first you look at your value, and if that value isn't, where you can walk away, because we've got some debt. Now, we've got a few years to knock down debt, because this business is still going to be worth 200 grand in 5 years, or maybe a little bit more. And so let's knock down debt, get our, personal budget in order for retirement so we can enjoy life. And then we sell in 5 years. A couple of years into it, you start putting some feelers out. Maybe you start training some, new staff to learn the business, and they might be a good candidate to take over. Or maybe they rent it from you, or maybe they just manage it, and you still have your thumb on the finances, so you can make a little bit of profit and enjoy retirement, and then sell a little bit after that. Just various ways to get there, but putting a sign on the window that you're for sale is generally not good for business.
Right.
If you happen to have a franchise business like a Dairy Queen, you don't advertise it for sale normally. What you do is you talk to your corporate rep from DQ, and quite often they'll have people in the system that are waiting to buy another Dairy Queen. And so, and then even I can say the opposite. I have a client who owns 4 Dairy Queens and would like to buy 5 more. So if somebody calls up and registers as a Dairy Queen client, first thing I do is ask Mick to assign them to me, because I can maybe help both clients. Let them negotiate the price, But in that case, it gets sold, and another Dairy Queen owner knows what it's worth, and you get away from a lot of the blue sky like you're talking about. Because it is the most difficult thing with a lot of owners, especially resorts, is that they feel their resort is worth so much more, because not too many years ago, developers would buy them and break them up, but you can't do that much anymore in most lakes. The laws have changed, the regulations have changed. So it's harder to sell a resort today than it was in 2010 or 2010.
Of course, if you wanna enjoy life, you get a job like Dane, you just go out there on the lake, you know, and have a.
Right, I can do it all from the pontoon.
Just from a resort owner.
Well,
Yeah.
but the other thing about the resort business, you know, when you go out there, you're gonna look to sell it. The thing is, you got lakefront, now this skews the whole thing, you know.
You got other
Look how
uses.
much this is worth here.
Yeah.
What's, how are you gonna pay the debt?
Yeah.
Just like you guys are saying, how are you gonna pay down if the bank isn't gonna let you do that, my friend? You can't pay that debt for what